Welcome back, everybody. Well, now that the S&P 500 has broken through the 1,000 mark, how much higher can it go before it runs into that age-old obstacle called technical resistance? For that, we bring in analyst Marianne Bartels. She's head of U.S. technical and market analysis over at Bank of America Securities-Merrill. Lynch. Marianne, good to have you back on Bloomberg. Good afternoon.
Good afternoon. It's great to see you, Carol.
It's great to have you here. I think for a lot, it was great to go through that 1,000 mark. How significant was it, Marianne?
It's actually significant. When you hit major barriers, and 1,000's a major barrier, and most of the time when you hit these barriers, you don't get through them the first time.
Right.
And right now, we went through it, and we're holding. And what we really like is on this move that we've had is we have great volume and breadth. And that confirms the breakout that we've seen since breaking the high of January's 944 on the S&P.
And that's significant, that it's not just a few players leading the charge, that it's really broadened out here.
That's correct. It's broad-based, and we have volume confirmation. I mean, this is like a technical dream.
Now, let me ask you, let's say, okay, we held above 1,000 again today. What happens if tomorrow we dip below it or the rest of the week? Is that significant then again?
No, you can even go as low as 900 and still have a technical breakout. In fact, it's very common because we broke a couple of key things. There are patterns that's called a head and shoulders bottom, which we broke out of, and we also broke down from the downtrend lines from the May high. It's a combination of both. So you can always go down and test those levels, but we've been holding above it. So with the confirmation of volume and breadth that we've been talking about, we also had the golden cross.
And that's significant. Remind everybody, that has to do with the 50 and 200-day moving average.
That's right. Golden cross is when the 50-day moving average moves above the 200-day. We found it's even more significant when it happens when you're in a defined recession. And it was really? Yes. So during a recession, it's more significant. And what this really, it was all over the news. It was in the paper, but a lot of people wrote it off. And since we've had the cross, the market's up 12%. So here again, we have another good signal of this golden cross.
So significant to see this golden cross in a recessionary environment, meaning what? That the move is then more sustainable or what?
The momentum is shifting, and it's shifting more towards the positive. So we had the golden cross, you have the breakout, you have the confirmation of volume, you have the confirmation of breadth. So we had targets at the end of March for the S&P to hit 1055, 1065.
All right, so that's what you're watching.
That's what we're watching. We have confidence that we're still going to hit those targets.
All right, so that's still a significant move to some extent from here. What happens once we hit those levels in your view?
Well, now the month of August, believe it or not, most market peaks actually happen in the summer, particularly in the month of August. September tends to be the weaker month. All the news happens in October. So we're going to start looking for negative divergences or signs that the market might be entering a correction.
Like what specifically?
One of the things that we're looking at is the percentage of stocks above their 200-day moving average. It's in overbought territory, but you can stay there. But if you start seeing that rolling over, going down, we're up in the mid-80s. We start going down into the 70s, and the market continues to go up. That's called a negative divergence. So in trying to outline and map out where we are, we do believe we're in a base building process. We've broken out. We think we can have a correction. It could be as little as 15% or the maximum of 20 to 30.
Okay, so it could be rather severe.
It's possible. When we study history, because we have to remember, if we hit our targets, we're going to be up 60% off the market low. In my entire career, I have not seen the markets move 60% in such a short period of time. Nor have I seen them come down so much in a short period of time. So it's very natural to retrace part of any move, right? So we're retracing part of the down leg. Well, now we're having this great rally, so we can retrace part of that rally.
Marianne, what about something like the VIX? We talk about it with the traders all the time. It's come way, way down. To me, that signals we're getting very complacent here in the market. Makes me a little nervous. But what about you? You watch this closely.
When we take a very long-term view, what we think is happening with the VIX is it's mean reverting back to its normal. Most technicians will use ranges between 20 and 10, and we're still around 24, 25. Right now, the VIX is not working for me. So that's one indicator that we've kind of put on hold as I think it's going through this mean reverting process. Another index we losed was the 10-day put-to-call ratio. As hedge funds aren't in the market as much, they're not using as many options, so that indicator stopped working. And that's common that you'll see an indicator occasionally stop working.
Just got about 20 seconds left here. When you look at things technically, are there any groups that kind of stand out that you think maybe have more room to run or more room to maybe fall here and you should watch out?
We're real bulls still on commodities. That benefits energy, materials, select industrials. But the emerging leadership is what we call mega cap multinationals or the emergence of the Nifty 50 again.
All right, so watch out for those guys. All right, Marianne, as always, great to get some time with you. Thank you.
Thank you very much.
Appreciate it. Marianne Bartels, she's head of U.S. technical and market analysis over at Bank of America Securities-Merrill Lynch. Matt, over to you.